Anyway, so today's topic is Rajeev is going to take the session, and we all want growth companies. We all are looking at a company which will grow fast. But how do you identify something which really grows fast? We make certain mistakes also when we make investment decisions, where you find a new idea and then you feel it's a great business. But there is something like a value in use and a value in exchange. Water is very useful for us. If we don't get water, we can die. But we get that free. You don't pay money for that. I'm not talking about the packaged drinking water, but you get it free. So it's got tremendous value in use, but hardly any value in exchange. Similarly, a diamond has fantastic value in exchange, but nothing in value in use. If you are dying something, a diamond cannot help you. Now, these are all the concerns which we have when we are making investment decisions. And one of the main investment decision is, a lot of people talk about growth, growth, growth. If you ask me, it's always in hindsight. After a stock which has gone up very much up, then you call it a growth stock. Or when fund managers, they are not able to justify buying expensive stocks, they talk about growth stocks. So today's topic is going to be that we are really looking at growth, and Rajeev is going to explain about what sort of scalability a business should have if you are really looking at growth. Over to you, Rajeev.
Good evening. Before we start our talk today and the projector boots up, last session we had a discussion on inflation and interest rates and things like that. So I just came across today's Times of India and it had a interesting thing. So on the cover there is an ad, and it is a cover which is that of January 6, 1963. And it also mentions the cover price as on that day. Times of India sold for 16 paise 51 years back. Today it sells for 6 rupees, and you get either Economic Times or Mumbai Mirror, etc. free, one of the papers. But just comparing 16 paise and 6 rupees, I thought it would be interesting to work out the number. What is the inflation rate of the newspaper? It came out to 7.4 per annum. So I just thought you guys would be interested in knowing, since last time we spoke about inflation rate and interest rates. Coming to today's topic, we are talking about scalable businesses. So scale is something, someone can reach a scale or someone can reach heights, and we are talking about that in the context of businesses growing to a particular size. Now, why does this question arise? Many of you would be familiar with this, but the founding team of Infosys were employees at this company, Patni Computer Services, before they started Infosys. Many years later, the founders of Patni sold off the company, and they realized 4,600 crores for that company. And virtually at the same time, Infosys, which was created by people who left Patni and they founded Infosys, that company had a market cap of 1,86,000 crores. So the question is, how do you distinguish between the two kind of companies? How do you identify a company which will reach a certain amount of scale? And how do you identify points at which companies may stall, so they may stop growing. As far as the past goes, everyone has 20/20 hindsight. We know perfectly well what has happened in the past. But it's the future where there is uncertainty. So essentially there is this dilemma. We've in fact had a full presentation on the first part. Those who have knowledge don't predict. Those who predict don't have knowledge. We have spoken about how experts get it consistently wrong in a lot of things and still they persist with forecasting. Despite knowing this, that future is uncertain, and as someone jokingly said, the future isn't what it used to be. So despite that, we can't get away from making some assumptions about what will happen in the future, because we can't, when we are driving a car, we have to look out of the windshield. We can't just look at the rear view mirror, look at past financials, look at past growth rates and then make our investing decisions. So again, Buffett has said this, the investor of today does not benefit from yesterday's growth. So that's the dilemma. And over many years, over so many letters to partners, so many letters to Berkshire Hathaway shareholders, interviews, whatnot, Buffett has said a lot of things about investing. Unfortunately, he has said very little about growth. He has spoken about growth, but not to the extent that one would like. On the right hand side, we have Charlie Munger, who is a difficult person to understand. So whatever he says, one has to read and reread and probably revisit after a few years. He has given a talk which again was a bit obscure. I'll come to that. And we have our Indian investor Rakesh Jhunjhunwala. I don't know, he calls himself a trader as well as a investor, who supposedly is very different from the other two guys, Buffett and Munger, but he also has said something about growth. So essentially we'll try and do some synthesis. I think this is an area where not too much is written about or not too much is known. The other things that we spoke about, Buffett checklist, that is well known by now. So Buffett says buy a business, don't buy a stock. He says you should partner with honest and competent management and it should be easy to understand. There should be some moat, so on and so forth. High return on capital. You should buy with a margin of safety. All this is well known, and last 4 years, 5 years we've been talking about these aspects in various presentations. The question is, after this what? You have two companies, both companies have good management, both companies have high return on capital and so on and so forth. Ultimately, you come to a question of which company will grow, which company will not grow. So this is what Buffett has said about growth. He talks about this categorization that people do. People say, oh, I am a value investor, and some people say I am a growth investor. He says this is rubbish. He says ultimately all investing is value investing. What is value investing? You buy something which is trading at a discount to its intrinsic value. So where does growth fit in? Growth is a component of value. A business which is growing is likely to have a higher valuation, and a business which is not growing is likely to be valued at a lower level. That is provided it has all the other characteristics. Sometimes growth can be negative intrinsic value. So if an airline is growing very fast, doesn't mean that it is giving profitable growth. So he has this to say. He says growth is always a component in the calculation of value, constituting a variable whose importance can range from negligible to enormous and whose impact can be negative as well as positive. So this is essentially the gist of what he has to say about growth. He hasn't written much about how to go about identifying the next multi-bagger or how to go about identifying the next growth stock. And he says, I always go by predictable things and I don't want to try out new things and things like that. So what have the other two guys said? Munger gave a speech, and as a component of that speech, there was this thing, how to turn a $2 million business into a $2 trillion business. So essentially how to convert 20 lakhs to 2 lakh crores, that order of magnitude. And he gave certain observations as to how to go about growing. And again, just like Charlie Munger is difficult to understand, Rakesh Jhunjhunwala also does not try to explain too much. He tries to entertain people more. So he will have these pithy one-liners and he will jest about and whatever. So this is something that he keeps saying. I try to find out whether the promoter uses the Tally accounting package or whether he uses SAP. So we'll look at what these things mean in the investing context. Now, despite these investors being very different, Rakesh Jhunjhunwala calling himself a trader and a speculator and an investor, and Buffett saying, oh, I am only a buy and hold forever kind of a guy. If we look at what kind of companies have made a lot of money, Buffett made a lot of money in Moody's and Rakesh made a lot of money in CRISIL, which is essentially in the same business. Buffett is the owner of a jewelry store called Borsheim's, and Rakesh Jhunjhunwala famously made a lot of money in Titan Industries, which owns Tanishq. So two very different people have come to similar businesses and have made wealth in similar kind of activities. So how did this happen, and what are the themes to look out for? How do you identify the next Tanishq, or how do you identify the next Moody's? Before we start looking at growth, we'll look at what are the possible sources of growth. There can be others. This is just an illustrative list. A lot of people make the mistake of just blindly extrapolating, saying this company has been growing at 20% in the past 10 years. I'll be conservative and I'll project a 15% growth rate for the future. Now it's not so easy. You have to look at what are the things which will continue, what are the things which will change. So for example, if telecom companies have been growing at 30%, but if mobile penetration is reaching peak, then future growth rate will flatten out dramatically. You could even see a decline in subscriber numbers. So you have to essentially see what will cause the growth rate to continue or to change. So growth can come from various sources. You can have more people in the same market consuming your goods or services. That is one source of growth. You can have new category of customers. So for example, if Gillette is selling shaving products to men and it comes out with a razor targeted at women for shaving legs, then it's a different category of consumers. You could have that kind of a thing. Or if HP is targeting printers at the office market and it introduces printers which are suitable for home printing, then that is a new category of customers. You could also have companies going to new geographies. If someone is just selling in India, starts exporting, then that is a source of growth. You could have various new variants being introduced or product extensions. So if someone is selling coconut hair oil, that person ventures into cooling oil or almond oil or something, then that could be a source of growth. Also, growth could come on account of gain in market share. So if Jensen and Nicholson is losing market share and Asian Paints is gaining market share, you will see Asian Paints growing even if the overall market does not grow that dramatically. As we have seen, all growth need not be wealth creating growth. What we are interested in is wealth creating growth. So even if you are someone who is a proponent of growth investing or someone who likes companies growing very fast, you cannot avoid the Buffett checklist that we saw at the beginning, because then you will be left with companies which grow very fast but which then have a flame out. We have seen Kingfisher Airlines. Maybe a couple of years back we had seen the balance sheet of Pantaloon Retail, where we saw the kind of debt, the kind of return numbers that were there. After we had that discussion, we have seen Pantaloon go on a selling spree where they have sold a lot of businesses to either their competitors or they have exited segments, and overall growth has not been that good. We had also seen the balance sheet of GMR Infrastructure some time back, and if you have been following the media in the last few years, they again have been on an asset selling spree because the growth was far more than what they could digest, or growth was more than what could be profitable for the shareholders. So sometimes things can be very obvious. You need not project a lot of things. It stares you in the eye, and that is where you can make some assumptions about growth. So when internet came in, it was a whole new way of doing things. So leaving aside the question of which companies will be profitable, you could clearly see that people will probably stop sending letters and use email more. Now that was something which was very simple, and even if you can't identify things which will benefit from a trend, this helps you in exiting businesses which are dependent on the old way of doing things. For example, if MP3 players come in, then you can clearly see that CD players will be on the way out. You may feel that there is too much competition in MP3 players and so on, and may not buy some business over there, but at least if you are owning a CD player business, you should try and exit that. Similarly, if digital cameras come in, photo film should be on its way out. So these broad trends are visible over many years. We are not talking about catching a small blip. We are talking about multi-year or decadal trends. Also, sometimes what happens is, based on our travels, based on our reading, we come across a business model which has done well in the developed countries. If that similar model is introduced in India, you have some bit of an idea as to how that will do. So, for example, Jubilant Foodworks did reasonably well in India, and the concept was proven in the Western market, where people who feel lazy, who don't want to go out to a restaurant to have a meal, and they don't want to cook either, just pick up the phone, dial a meal, the pizza is delivered to your residence. So these kind of business models, if they have worked in the West and if they are suitable to the Indian market, then you could see reasonable amount of growth coming from these business models. However, just because there is market potential doesn't mean that it will be profitable to shareholders. Many a times what happens is, if there are too many new players in the market, they compete away all the profits that are there, even if the overall sales are growing. So what you also need to see is whether there are any entry barriers and whether some people can capture the market exclusively rather than it becoming a free for all. And if there is a plethora of Me Too products, it can destroy wealth. Also, one good way of identifying companies is to look for sectors where there are sitting duck competitors. Competitors who have absolutely no interest in running the business well and who are there to lose market share year on year. So we saw this in telephones, where with the entry of private sector players, MTNL, BSNL kept losing market share for many years and are probably still losing market share. We have seen it in PSU banks, and still PSU banks are the dominant players. So this trend could continue for probably many decades more to come. We have seen this in airlines, where Indian Airlines was a state monopoly and it kept losing market share once private sector players came in. And I'll let you know a secret. When Titan came out with Tanishq stores, I got to know it, I looked at the balance sheet, the numbers were looking horrible at that time, at the early stages. I gave it a pass, and since then the stock has done dramatically well. So I couldn't see it at that time that this company will do really well in the days to come. But what I did not realize is that the competitors were sitting duck competitors. So single outlet stores, people who would cheat on the quality of the gold that was sold, people who would not buy back the gold which was sold from their store, and things like that. And here a company came in with a trusted Tata brand name behind it. The selling proposition was, get gold from anywhere, come to our store, test it, we'll tell you how much is the purity, have the installment saving scheme, will give you the 12th installment free, and so on. So for a long time the dominant players just kept quiet, thinking that it won't affect them, and by the time they woke up it was too late. Similarly, Kirana stores have a big advantage in wet groceries, but otherwise traditional way of doing things, limited variety, no discounts and so on. So when modern retail comes in, you will see a multi-year trend where overall market share of organized retail grows. It will plateau at some point, but these are some things which take place over a period of time. Even in the field of stockbroking. So we saw a situation where bank promoted or financial institution promoted brokerages started coming in. Whereas with a traditional broker you had to cut out a check or fill out a demat slip. These people were technologically savvy, internet enabled, they linked all the bank accounts, demat accounts and brokerage accounts. So you saw a situation where they rapidly gained market share, and also the trust factor was there. So they were well capitalized and people found it easy to trust a lot of these players. So you saw market share of these players going up. Again, we have discussed this. Interestingly, Hero Honda versus Bajaj Auto. Bajaj Auto, almost a monopoly player. You had a waiting list of as much as 5 years to get a scooter in the license era. A competitor is allowed, Japanese technology, fuel efficient vehicles, product almost available on demand. I think writing was clearly on the wall that one company will go down and the other company will ascend. Maruti Suzuki coming in, Fiat and Ambassador had to go down. I think it did not take too much of a rocket science to figure these things out, and these things don't happen in 3 months or 6 months, these happen over many years. Similarly, NSE came in, BSE was like a closed club, ring based trading, NSE electronic trading platform, obviously it had to gain market share. This is where that question comes in. Does the company use Tally or does it use SAP? Now, if your blueprint says dig only 5 feet to lay the foundation, obviously you are not going to build a Burj Khalifa over there. Whereas if you are digging maybe half a kilometer inside, then you are going to build a very tall tower. If someone is using Tally software to account, then that person can have a single location store or can have 2 or 3 outlets. If someone is using SAP, then obviously that person has a design for a nationwide network. So business design is important. So sometimes you can get understanding of whether a company will grow or not depending on the nature of its activity. So for example, if someone does a stage play, now that person has to enact that same play over and over again, and that person can perform in front of an audience which is maybe 500 people, 1000 people, 2000 people. There is a limit. Whereas if someone is a movie actor, you record the thing once, you can play it over and over again, you can broadcast it on satellite television, you can have theatrical release and so on. Now I'll just, again, Infosys versus Microsoft. Infosys has to write a code again and again for its clients. It has to program the software. Microsoft makes a copy of Windows, then that CD can be sold at various outlets. They don't have to write the program again and again. So I'll discuss one company that we were debating internally. We were debating a company called MT Educare. This is Mesh Tutorials, where the company basically takes these coaching classes for students. It's a segment where people are willing to spend a lot of money. People want their children to have good education. Financials seem decent. There's nothing that we have against the promoters. So far their track record is relatively clean, so no problem over there. We finally came to this question of scalability, and there was a fierce debate in our company. We couldn't come to any conclusion over here. One view was that this company is standardizing a lot of things and making it scalable. They are putting in place systems. The counter view was that teaching is a very personal thing. You either like a professor or you don't like a professor. If a professor is popular in the value chain, that professor is going to extract the maximum value, and if that professor quits and joins a competing class, students are likely to move. So again, we have these news channels, NDTV, CNBC, Times Now. Question is, who is the star? Is the television channel the star or is the anchor the star? So companies which are too dependent on one or two individuals or on the star power of one or two individuals have a problem of scaling or sustaining. And this question came about in even a company as large as Apple. So is Apple independently a very innovative company, and can it continue growing, or has some of its value been lost by the demise of Steve Jobs. And a lot of people have this question even about Berkshire. So is Berkshire a company which can sustain on its own, or is it too dependent on an individual? So this question is important. Can the business run as a machine rather than be too individual driven? And again, are there economies of scale? So if you are running a BPO, to grow you have to keep on adding seats, you have to keep on adding employees, and each employee will add only that much of revenue. Whereas if you are running a stock exchange, or if you are running a company like a MasterCard or a Visa, then once you put that infrastructure in place, then the network effect comes into place and your business can grow without too much of additional effort. So this also gives some inkling as to how scalable a business is. Another important thing to look for when coming to a judgment whether a business can grow or not grow is to somewhere get a feel of the promoter DNA. People who remember when private sector banks were introduced, HDFC Bank was formed and Times Bank was formed. Times Bank was promoted by Bennett and Coleman. HDFC Bank was promoted by a financial company, HDFC Limited. Aditya Puri, a career banker, was hired to run the bank. He had a successful track record of running banks in various countries for Citibank, and he brought in a good team in place and formed the bank. Whereas in Times Bank, although they recruited people from outside, at the top the key decisions were being made by people who ran the newspaper. This is, I know anecdotally, the senior management was grafted from the newspaper business to the bank, and obviously they felt that there was not much future and they quickly merged it with HDFC Bank. So by looking at the track record of the people and coming to some estimate of their capability, you can see how the business will pan out in the future. And to grow, like it is said, that to run a restaurant chain or to be a good food business person, it is not only necessary to know how to prepare a dish. A good chef may not be a good business owner or a restaurant owner. When you run a business, you should have the ability to manage people, you should have ability to manage production, keep up the service quality, handle various far-fetched branches and locations. Sometimes raising finance is also a key. So if bankers and if investors don't trust you and you can't raise money, your business will again stall. Some businesses require handling a lot of compliance or regulatory issues. So essentially, the people running the business should have the capability to do all these things. Otherwise, past growth is not reflective of what is going to happen in the future. So for example, we have seen these kind of companies in the past which have generated tremendous amount of return for shareholders. So what we are trying to do is, how do we identify the next HDFC Bank, how do we identify the next Hero Honda or Titan? Again, the future is uncertain. The best thing to do is don't pay for growth, get it free. So keep the buying price such that that margin of safety concept is kept intact, and if growth comes, it should be a lottery to you. So that is the best thing to do. And finally, despite whatever I am going to say later on, don't buy any of these stocks tomorrow morning. Keep patience, wait for the right time, and then keep observing what is happening to those kind of companies. And I will give you a interesting example as to why to take everything with a pinch of salt. Which of these two watches is more accurate? The one on top. Which of these has more features? The one on top. Which of these is more expensive? The one on bottom. This is like your MP3 player and this is like your gramophone record. When digital watches came in, people said, why will anyone wind up a watch and wear that? There was a watch which would only give you time. It would not tell you whether it's AM or PM. It would not give you multi-year calendar. It would not store your phone book. It would not function as a calculator. It would not function as a stopwatch. Various things it could not do. And for a certain amount of time, the Swiss watch industry kept on declining and people were wearing a lot of these digital devices. Finally, the Swiss watch industry reinvented itself, came back as a fashion accessory or a jewelry kind of thing. Today they don't even talk about time accuracy. They would lose in front of that digital watch. And the prediction did not turn out to be true, or the trend that was visible, a multi-year trend that was visible, halted and reversed also. So these kind of things happen in the markets and one should be constantly on the watch out. Despite Buffett recommending buy and hold for many years and decades, it does not absolve you of the responsibility of monitoring the businesses that you own or monitoring the developments. So we will be discussing some of the things that could do well in the future, and I could have a vested interest in all of them and I may change my view also, so we have to be cautious about them. This thing is very underappreciated. People say it has already gone up 10 times, now what is there in the future? Now let's find out something else. I think that is one big mistake that people make. Despite the strong growth of companies like HDFC Bank and ICICI Bank and HDFC Bank and all these, today majority of the business in India is done by public sector banks. Public sector banks where the chairman, executive director, they come there for 2-year stints. The executive director of one bank, when he is promoted, joins a competing bank. It's not that that person grows in the same bank. Every new person who comes in makes huge provisions for the past loan losses and then goes on to make a lot of new loans. There is an element of political interference and so on. So according to me, these people are sitting duck competitors. And anecdotally, one person who worked with a SBI subsidiary, he had a salary account with SBI. He went to the branch and said, I want to open a PPF account. The reply he got was, oh, we have too many accounts, we don't have more capacity, go find another branch. So this is the kind of answer that is given to your own subsidiary or your own employees. Forget about outside customers. So what has happened to MTNL, BSNL, or what has happened to Air India could happen in slow motion to a lot of these public sector banks. No one has that kind of interest in growing shareholder wealth in these banks. Their interest is their own promotions, keeping the bosses happy and not to rock the boat, that kind of a thing. So possibly you could see some growth coming with private sector banks. Just because they have grown in the past doesn't mean it will stall now and it won't grow in the future. Jewelry business again, although some new players are coming in, something like Titan could continue to do well. I am not commenting on the valuations today. I don't own it and I don't intend to buy it immediately, but I am saying purely in terms of sales growth or business growth. 10 years from now, 20 years from now, as Indian economy grows, rating agencies in India could be much bigger than what they are, and their business model is quite good, as we have seen. FMCG companies again, with a lot of advertising and with promotions and whatnot, you could see kids brushing twice a day instead of once a day. If everyone starts brushing twice a day instead of once a day, that's 100% growth from current level. So a lot of things are underpenetrated in India as compared to the Western markets. You could see growth rate still continuing in a lot of these things. What one should guard against is not to extrapolate blindly. So Hero Honda did well in the past, but now Hero and Honda are separate. So does that change the market? One needs to monitor. HDFC Bank has done well in the past. Now it's majority foreign owned. Do the guidelines changed? New private sector banks will be allowed. Does that change the landscape? Foreign banks will be given more freedom. Does that change the landscape? So you should be continuously asking yourself whether the business environment is changing. Don't be trigger happy, but monitor things that are happening. And essentially, see, these are just random names I have put up and some of the stocks that I own, but food being put in the microwave is a established Western concept. So when this Act 2 popcorn was introduced in India, popcorn is something which kids love, and if you can put that packet in a microwave and get hot steaming popcorn, or put that in the pan and get popcorn, it's a surefire product. On a low base, these kind of products can have phenomenal growth rate. So similarly, you could have a growth in a segment like timeshare or in artificial sweeteners or whatnot. So basically identify things which are underpenetrated and which have a potential to grow, and then after you do all the work and come to some conclusion, then you should have the patience to sit tight. These kind of things will not give return on a day-to-day basis or even month-to-month basis, but if you look at things after 5 years, 10 years, you could see a lot of multi-baggers. So any investor that you take across the world who is successful, you look at their top 4-5 ideas, 6 ideas. That will have made them most of the money, not what they do every day. Every day purchasing and selling can give you entertainment. It cannot generate a lot of wealth for you. So that is the framework I wanted to give for the growth, evaluating growth and scalability. I'll be happy to take questions and any observations that you may have.
Just an observation, most of the points that you discussed essentially define a moat, right? That's what makes good businesses, like Buffett says, a time is a friend of good businesses. So
no, it's actually much more than moat. Kodak has a huge moat in digital films, but digital films is declining. That segment itself is declining. So is that a great business? Or forget, Kodak may be a bad example. You may have a big moat in a particular sector, but that sector is not growing at all, and the market share of the two players are constant, in which case you may not see that growth coming in. What we are trying to do is look at demographics, look at underpenetrated categories, look at possibility of entering new geographies. Here we are talking about growth. Moat is a separate concept. Moat should be there as a precondition, because if moat is not there, then if you have 50 players competing for one segment, then none of the players will have a profitable activity. Moat is essential but not sufficient. It is necessary but not sufficient condition for wealth creation.
And just another question, what do you suspect went wrong with the watch scenario? I mean, that's an excellent observation, but at the same time, I mean, what went wrong? Because I mean, that was a classic case for a trend swap, right?
Actually, possibly the trend has still not stopped. So now we are having these variable computing. So Samsung phone plus smartwatch, and Apple is rumored to be developing something. So finally, maybe 5 years from now, again we'll throw away the Rolexes and Omegas and all that. But that was a very clever piece of marketing, where it was clever marketing, where you don't want to be seen around with a 50 rupee or 100 rupee wristwatch. You want to show people that, oh, I own these many lakh worth of watch.
But it became a piece of jewelry more or
It
less.
became a piece of jewelry, yes.
But a lot of these growth factors that you mentioned, one thing which can, everything else being there, one dampener could be government and regulatory policies. You know, there could be growth, there could be demand, there could be geographies. Like let's say power sector, you know, we know there is a big demand, fewer players, there's a barrier in terms of the capital requirement and things like that. But again, a highly regulated industry, and policy changes killing the whole setup.
So there is in what we call signal and noise. So there is one broad direction that is there, and within that you will have ups and downs. So when the ocean is moving from a low tide to high tide, broadly you will see water coming further and further inshore, but each wave will keep coming and going. So similarly, all these factors, government policies or regulation and all that, they can shift the growth rates, or they can stall growth rates for 3 months, 6 months, but broader trends they cannot deny. So if your demographics say that in China, because of the one-child policy which was followed for so long, 10 years from now, 20 years from now, there will be a lot of old people and fewer younger people, and demand for old age homes will be high. If that is your hypothesis, now government policies cannot completely override that longer term trend. Or if MP3 players are replacing audio cassette tapes, government can give subsidy to something. Or if power loom is replacing handloom, government subsidy can sustain handloom for a certain amount of time, but it cannot negate the broader trend. So you have to look at broadly what is happening to the world.
So in this case, the classic case would be the ban on gold imports, or rather the, not ban, but the restriction would be essentially an entry point into a stock like that. Not that I mean, not absolute, but just hypothetical.
Yes, because all that it has done is added to smuggling. It will not change the mindset of people, or it will not change the consumption habits of people. So our old Hindi movies had this, like Diwar and all had Amitabh Bachchan as a gold smuggler. Probably a few years from now we'll again see Ranbir Kapoor as a gold smuggler in some of the movies. So we are coming around a full circle.
You know, just thinking logically, if you see the GDP per capita is around say $1,500, as this moves to $3,000, $4,000, $5,000, you know, the expenditure on staples would, referring to your FMCG slide, could probably remain similar, like the growth rates could be 10-15%, but won't the real explosion come in everything aspirational, everything discretionary, where people want it but they couldn't really afford it? till now. So isn't that where like 10-15 years down the
Sure.
line you really see big growth?
Sure. So within FMCG you will have different categories. So something like a bathing soap or a washing soap probably already has most of the penetration, but something like a perfumery or cosmetics or deodorant, that doesn't have that penetration, and that would be the more the aspirational kind. So each segment will have to be evaluated separately, but sure, aspirational products would do well if economy grows.
I'm just combining your last presentation and today's, and if you take both together, and if you're looking at scalability and you're looking at everything, then if you see that graph which you showed, those companies which after 5 years remain in the same segment of star performers or underdogs or whatever, why not just buy the best companies, because all of them are scalable, all of them have the best products, all of them have the capacity to augment capacity, to add capital if required, to do the required marketing. All of them have R&D. Instead of looking for this so-called multi-baggers, let these companies keep bagging themselves.
So what we are trying to do is identify which ones. As this question pointed out, should we buy Lever, should we buy ITC, should we buy Titan, or which? When you actually come down to it, so we have eliminated all the faltu ones over so many years of doing FOF and putting the framework and all. We will eliminate the wealth destroying ones, hopefully. We will not get into the big mistakes. We will not buy the next Unitech in 2007 or next DLF. But having done that exercise, what next? Which one to really go out and buy?
All these.
Rajeev, what he says is you buy all the blue chips which are there. But then my argument would be Mafatlal Fine, Mafatlal Industries, Orke, they were also once upon a time all blue chips. JK,
No, blue
JK,
chip,
everyone, JK, Great Eastern Shipping, it all changes the
blue chip word is slightly different.
No, here what you are saying, why should I not buy L&T and sit down?
No, I'm not talking about L&T. I'm not talking about these very sectors. I'm talking about Lever, ITC, Colgate, and which are the other companies you mentioned? HDFC Bank. Right? Now all these companies are already doing well. All of them are scalable. Today, if HDFC Bank wants to double its branches, it already has the infrastructure and the capital, and it can raise itself. Right? Why look out for a new multi-bagger?
But you think it's that simple, the investment world, is it that simple that you buy this and then you sit down and nothing will happen?
Mehul, I'll explain that. So when we are saying looking at multi-baggers, we are talking about getting something which will have exponential growth, hopefully, and we want that exponential growth to come to us for free. We don't want to pay for that upfront. So when you have a choice of either buying Lever or buying something like Agrotech Foods. Now Agrotech Foods is also a multinational owned by Conagra out of US, and when you see the first ads of Act 2, my instinct would be to buy a Agrotech rather than a Lever, because somewhere the base effect comes into place. So if you are buying an Infosys today, growing something which is maybe worth 1.5 lakh crores or 2 lakh crores at 20% year on year becomes difficult. But growing something from a low base 100% is not that big a task. So somewhere when you look at various businesses and look at these factors with the same quality, you may come across something which is currently smaller, currently having higher growth rates, and something which has good potential.
I tried tracking this Rakesh Junjunwala, and he spoke about growth, and what he said is in scalability, he sits one-on-one with the management and he takes his own call whether it's scalable, and still he says half the time he is wrong in that.
Correct.
But if you see his choice of scripts, he is wrong 90% of the time in scalability.
Correct.
So if he, with all his wisdom and all his, is going to be wrong 90% of the time, where does a guy like us?
So one important thing is, don't overpay for that or don't pay for that growth. So even if it doesn't come as much as you hope for, you don't lose a lot of money. So that is one definite thing to do. The second mistake, in my opinion, what Rakesh Jhunjhunwala does is, he doesn't go through the Buffett checklist. So he gets into a lot of things which are capital intensive, which have low return on capital, which don't have entry barriers and moats and things like that. So he may get his call right in terms of the sector growing very fast, but that may not result in very profitable growth. For example, he was one of the early investors in Pantaloon Retail, and that company has not done that well. You see Big Bazaar all over the country, but for shareholders it hasn't done that good. So those are the additional factors I think one should match with scalability. You can't look at scalability in isolation.
Just to carry the point forward, when you buy like a Nestle or Lever or whatever, everyone knows these are good companies. So using any basics of psychology or behavioral finance or whatever, if you spread in these companies, logically you just end up with mediocre returns, because everyone knows these are the best companies. So obviously the value will be, you won't get it cheap. And even if the market is cheap, it could be bipolar, like these companies are always going to be expensive. So isn't it logically always better, though the risk may be higher, to buy a agrotech instead of a Lever?
Not always. So in 2007, for example, all the quality names were being thrown away, and you had the story stocks having a fancy. Same applied in the year 99 and 2000, where technology was fancied and what was called old economy was not fancied. So it varies from time to time. Broadly what you are saying is, most of the times smaller companies, mid-cap companies have more value in them, or they tend to do better if chosen carefully, but it does not hold true at all points in time. Today that may be true because there is this fancy for quality names, and they have been bid up quite heavily in the last 2 or 3 years. Thank you so much.